So, Sean Lucas, thanks so much for joining me today to talk about net zero and some of the accounting implications. But before we get into accounting, Sean, I thought it'd be interesting to hear what you're seeing in practice from working with your utility clients and others in the area of net zero.
Sure, Heather. So we're seeing, as you might imagine, a lot of activity. So in the utility sector, for example, utilities have announced the closure of fossil fuel power plants to achieve their goals. And then in other sectors like manufacturing and technology, we see companies indicating that they're going to close or upgrade certain facilities to move to a more greener manufacturing process, or that they plan to contract with third parties, such as wind providers or solar providers, to procure green energy. And companies are making announcements around all of these efforts. And it's the announcements that I want to focus on first, because those announcements can actually have accounting consequences. And these announcements can come through all sorts of public filings, quarterly reports, annual reports. They can come through press releases. They can come through statements made at industry conferences. All of these things need to be considered because once an announcement is made, it can trigger an accounting consequence, such as a potential long-lived asset impairment, a possible uh, acceleration of depreciation for certain assets, or possibly get into things like lease accounting, derivative accounting, or actually consolidation of third-party arrangements. All of these things need to be thought through. And the important part is that there's so many departments that are involved in making these announcements around ESG, whether it be HR, IR, accounting, finance, many others. And you really need to have good processes and controls in place to make sure that before an announcement is made externally, that the accounting team within a company is able to think through that announcement and anticipate the potential accounting consequence of an announcement before it's made to avoid accounting surprises.
Sean, as I think about the strategies companies are taking, there's really three areas that we normally think about. So, one is to reduce emissions, and we'll start with that. And then to offset emissions is kind of the last strategy. And then, sort of in between there, we also have an idea of capturing emissions. But as we think about accounting, I'm going to start with the first one, which is reduce. And this is really then focusing on investing in renewable energy projects or buying power from renewable energy projects or even buying something called a renewable energy credit or a REC, which Lucas is going to talk about a little bit more. And again, when I talk about renewable energy, I'm talking about things like wind and solar, hydro. And as we think about the accounting for these various types of arrangements, I would just remind people to kind of go back to the basics. So if you're making an investment, whether it's in a renewable energy project or otherwise, doesn't change the accounting that you need to think about. So should you consolidate? Do you apply the equity method? Should you apply the cost method? And then if you're applying the equity method, often these arrangements will have sort of uneven profit distribution. So there's some unique considerations there. So that's also something to think about. And then if you are entering into a power purchase agreement with the renewable energy facility. Sean touched on this very briefly. You have to think about things like consolidation, lease accounting, derivative accounting, or potentially executory contract accounting. So definitely also a lot to think about there. And then final point would be even some of these arrangements, we're starting to see batteries involved. And so if you have a battery that you're charging with electricity, then do you have actually electricity inventory that you need to be thinking about and other considerations as well. And that's definitely something we didn't think that, 10 years ago was not something we were talking about. So Sean, again, going back to you from a practical point of view, what other types of questions are you getting or what are you seeing in terms of where companies need to focus in this area?
Well, I definitely agree with what you just said. I think ultimately what you're hitting on is what we call the contract framework evaluation. And the key reminder here is that when you enter into an arrangement to procure power, such as a manufacturer procuring power from a wind farm or a solar farm, you shouldn't default to accounting for that contract as an executory contract. It could possibly be a lease. It could possibly be a derivative. You might actually need to consolidate that entity on your financial statements. And so you really need to run through this contract evaluation framework to decide how to properly account for that contract.
Lucas, let me bring you into the conversation and let's talk about something I've touched on, which is the accounting for the renewable energy credits, or RECs as they're called. And then something else that we only mentioned briefly, which are carbon offsets. How do we think about the accounting for those types of instruments?
Well, yeah, thank you, Heather. It's a great question. And certainly we're seeing a lot more use of RECs and carbon offsets as part of companies' net zero strategies. And I thought what I could do is define both of them and compare and contrast them, and then talk a little bit about the accounting. So if I think about renewable energy credits, what those really are is a verification that power has been sourced from a renewable energy source. So wind, solar, hydro. And RECs have been around for a number of years. They're typically certified by state agencies that that power is actually sourced from those locations. And the benefit to the holder of these renewable energy credits is they can claim the benefit of that low or no zero emissions power. And so that's really how it plays into a company's strategy. To move on to carbon offsets, which are something that is really new and growing a lot of focus for companies, is carbon offsets are really a way for a company to invest, if you will, in technologies, in things that are actually going to extract emissions from from the world, in effect. And examples of those, and you touched on some of those, Heather, reforestation is an example, carbon capture is another example, methane capture as well is a third example. But there's a number of these new ones every day almost that companies are focused on. But if you think about the benefit for a company is, a lot of times a company will look forward and say, well, I can't actually get ultimately to net zero. I'm always going to have some emissions in my value chain. What these provide is by purchasing, investing in these carbon offsets, a way to offset those emissions that you know are going to have. And so that's why I think we're seeing a lot more focus on these in the marketplace. The other point I wanted to make here, and I think it's an important one, is, I touched on RECs and the validation by state agencies. That's long been done. And so companies that have RECs can certainly believe that power is from renewable sources. I would tell you with carbon offsets, the market is evolving. It's a lot less mature. And so the maturity of that validation process is not as strong yet for carbon offsets. And the point I'd make for a company to be aware of is you really probably want to do some due diligence before making those investments in carbon offsets to ensure those are in fact going to result in reduced or take emissions out of the world, if you will, and can be measured. And so just to highlight that, I think it's an important distinction between RECs. As it relates to the accounting model, what's interesting here is there's actually no explicit gap for accounting for either RECs or carbon offsets. And so we believe that to the extent you're holding these carbon offsets or RECs for use in your operations, and if you think about that, that's for use in meeting net zero strategies, that there are two accounting models that one could apply. So it's an accounting policy election. And those two models are the inventory model and the intangibles model. And so there are certainly differences in the subsequent accounting, depending on that accounting election, such as balance sheet presentation, cash flow presentation of the cash inflows and outflows for the activity, as well as a different impairment model that companies would apply, whether it be the inventory impairment assessment model or an intangible model. Heather, I wanted to come back to you because I know you've been getting a number of questions on this. Anything else to add as it relates to some of the questions you're getting on carbon offsets or RECs?
Yes, so Lucas, it's interesting where I chime in. You made the point about expensing, and that probably is the number one question that we're getting is, I think there's a presumption from a lot of companies that if they are buying these to meet some type of a net zero goal, and again, I'm talking specifically about voluntary programs here, that, okay, it's for my goals in 2021. I'm buying these in 2021. I'm just going to expense them immediately. And I think what's really, really critical is you actually do own an asset. And as you said, for example, with RECs, that's even something that's been certified typically by a state agency. And so until you actually turn in that REC or turn in that offset, you do continue to own that asset. And so that it should not be expensed until that actually is retired. And again, I think that's probably the number one thing that we're seeing that's taking some companies by surprise. So something I would just highlight as we focus on that area. So maybe let's turn then in our round robin to our last area. And Sean, I'll go back to you for this question. And this is on the area of new technology. And again, I touched on it early on in our discussion, but what are we seeing and how are you thinking about the accounting?
So we're seeing lots of things in this area around ESG and new technology. You can expect we're seeing companies abandoning older polluting equipment. I talked about getting rid of the old coal plant, for example, in the utility sector, getting rid of polluting equipment and replacing it with highly efficient assets. And the accounting impact can be similar to what I mentioned earlier. The real focus is on cost capitalization, what new costs can be capitalized, what old costs need to be removed from the balance sheet, either through an impairment or an acceleration of depreciation. Some companies are involved in R&D, and generally speaking, we would expect those types of costs to be expensed unless it has an alternate future use. But I think generally speaking, we'd expect R&D costs to be expensed. And then lastly, we are seeing some companies tap into available government grants. And to the extent that some of the expenditures or all the expenditures relate to government grants, you need to think about following a grant accounting model, which can be tricky. And so you need to really, first of all, read the grant contract to make sure you're dealing with the correct accounting and reporting impacts of those grants.
All right, definitely important points to consider there. And Sean, Lucas, thanks so much for joining me today.